So welcome everyone. Welcome everyone to our YouTube live. And I think at the moment markets look a bit wobbly. So we've only started this year, 2024, but already we've seen some fairly big moves in the US markets at least. The US in particular, I'm thinking about Apple because that's been downgraded by two analysts and we've seen its stock fall as a result. Not hugely, but it's enough to wipe a lot of value off its market cap because it's, a $2 trillion company. So yeah, a little bit of a wobble, I think, to start the year. And it's interesting, if you look year by year, 2022, very clearly at the beginning of the year, that was the beginning of the tech wreck. 2023, it reversed almost, to the day. So who knows what this year's going to bring, but certainly at the beginning of the year, it's looking a little bit like it's going to be a sell-off. So we'll just have to see what the year brings. So now it's the usual story. We've got an hour together. Thank you for joining us. And please do like and share. And if you do that, then presumably it gets recommended to more people. So that helps us a lot. It doesn't cost you anything. So we'd appreciate it if you could do that. And I think also one thing I'd like to flag is this week we had a kind of interesting podcast, which my co-host Michael, it's his favourite episode that we've done so far. And we've done over 100 shows. So the one we did was on demographic shifts. Let me just share this with you. So these are the demographic shifts and also how they affect markets. Because that's a critical thing, isn't it? As an investor, we all know that the population's aging in developed markets and in places like China as well. But the real big question is, how is it going to affect your investment returns? What's it going to do to bond yields? What will it do to stock returns? And will it erode the 5%, 6% return that you get on stocks above inflation if the population starts to age dramatically? So those are the kind of questions we were discussing. And, we both had a great time shooting it, recording it rather. So please do have a listen. I think you'll find it entertaining. So now let's get started on your questions. Remember, if you are a supporter of us on YouTube, then you'll get pushed to the front of the queue for the questions. And also if you do a super chat, that also you get priority and you get pushed to the front of the queue for your questions. So let's just look through some of the comments. Someone talking about risk about currency exchange rates and political factors. I guess that's talking about EM perhaps. Love your videos. This is from Khalifa31. If bond returns will be as low as explained in your last video, and considering that central bank rates will decrease, wouldn't it be wise to invest in long-term ETF like TLT? Yeah. The thing about TLT is that it's got so much duration that it's very volatile. And the thing about bond markets is that yields seldom move in a straight line. It's not going to be a case that we're going to have a gradual move downwards in yield to push up the price of the bonds. It's going to be a rough ride because there are lots of things which move yields around. For example, if we have got a risk-off move, then that could be seen as a positive for the bond market because people panic into bonds usually. But if inflation looks like it's going to surge again, and it does look like oil prices are on the upward rise again due to geopolitical instability in the Middle East, then effectively that'll be a really bad story for government bonds, and that'll push down prices, push up yields. So I don't think it's as straightforward as saying, okay, yield's going down, I'm going to buy long duration. But certainly, things like the risk reward looks more attractive because there's a lot of convexity at the long end of the curve. So you lose less than you think you will if yields move up, and you gain more than you think you will if yields move down. So convexity is your friend when it comes to long duration bonds. But you have to have a lot of stomach for volatility in order to buy those bonds. And personally, I haven't really piled into long duration this year. Some of the pension crafters have, and I can see why, but I personally haven't. Simply because I think there are other opportunities. Now I have got a cold again. I'll apologise now. I have been told by Laura not to sniff because it's very loud on the microphone. So I'll try not to. So I hope that gives you my thoughts at least about what's happening to the yield curve. But certainly it looks as if yields are rising in the United States. I think it went up to 4%, something like that, on the 10-year yield for the US. And yields are rising presumably because growth expectations have surprised on the upside. So that's perhaps why yields have risen again. Not so good news for growth stocks, tech stocks. So perhaps this is going to cause a little bit of a wobble in tech and mega cap tech stocks and the magnificent 7 stocks, which did so well last year. Who knows? Next question. Someone says, actually, let's see if we've got any questions from, no, still nothing from our supporters. 39 years old. This is cinematographers. I have 90k to invest. Where should I allocate and distribute? Ireland, ISA cash, i.e. ISA cash, stock, S&P, equities, etc. Ideal balance of portfolio. Well, I can't answer that question because I don't really know you. I don't know anything about you. So, I don't really make these recommendations. So if you are making that asset allocation decision, I think it is worthwhile just stepping back for a minute and thinking about your goals. Because I think people often don't do that. They don't think I'm investing for this reason. This is where I want to be in 20 years' time, 30 years' time, and I'm going to build a portfolio that's likely to get me there. The way people usually think is, I'll take a standard portfolio, 60-40, and just hope for the best. Whereas I think the best way to do it is to think, well, that's my goal. This is what I need to do with my cash. This is my cash requirements over the next 5 years. I need to keep some liquid money just in case there's a demand on my kind of cash reserves. Perhaps I'll need to get a house repair. Perhaps there could be an emergency with the family and I need to fly out somewhere or help out my mother who's ailing. Whatever the reasons, you've got to have that liquidity bucket in place and an emergency bucket in case you lose work. So I'd say that's a fairly standard thing. So that you'd put into very safe things like cash or money market funds or short duration government bonds. And then if there's money you're not going to touch for a long period of time, you could put that into stocks. So here we're talking 10 years plus, more of it into stocks. But beyond that general set of principles for building a portfolio, it's really hard without knowing someone to, talk about their decision process in more detail. But we don't usually do that. We don't do that at all. In fact, come up with plans for people because we're not authorized. What we do is we teach people how to go about doing the allocation themselves. What are the principles? How can you make it tax efficient? So, for example, in the UK, we've got ISIS and SIPs and some other structures which are very efficient. Think about inheritance. Certain things are more efficient when it comes to inheritance tax. And of course, think about the asset allocation, which is my specialty. That's my background when I used to work in investment banking. So, yeah, I'm sorry it's a bit of a general answer, but the thing is I can't really tell you because I don't know you at all. And I wouldn't tell you anyway. Even if people ask me in a one-to-one coaching session, I always say, look, I don't give advice, but I can give you the principles to help you decide how to build it. And usually people prefer that because then they're in control of the decision, and for good or for bad, they ultimately are responsible for what happens. But there are certain kinds of behaviour that are likely to get you to where you need to be, and that's usually what we end up discussing a lot of the time. It's more of a behavioural chat, almost like a kind of therapy session, more than buy this thing or that thing, which I never do. I don't advise and I don't recommend stuff or funds. Anyway, sorry I can't be more specific. Any super chat? Oh, we've got 2 super chats. Thank you very much. So Matthew Dick, thank you very much. Here's a question. With the Santa rally fading and the Fed signaling rate cuts may not come as soon as the markets expect. Yes, that's right. One of the Fed governors came out and said it could be higher for longer than markets expect. Markets did get a bit carried away with themselves after the last Fed meeting. When to pivot out of money market funds? Interesting, because I've been asked that question a lot recently. Now, I think what people don't realise is that just as inflation is a rate of change, and it doesn't change dramatically over short periods of time much, that rate of change year on year, similarly, money market funds earn roughly the policy rate set by the central bank. Not exactly, but roughly. In the UK, they earn SONIA. In the US, they probably earn something more like the SOFR rate. But roughly, it's the policy rate from the central bank. That's what money market funds earn. That short end of the curve is where those money market funds feed in terms of generating yield. Now, the point is that the central banks are not going to suddenly cut rates very rapidly, because firstly, that would disrupt markets. A very rapid cut in interest rates is what they do when there's an absolute total emergency, like after the pandemic hit or after the financial crisis really kicked off. No, what they'll do is they'll do a gradual set of rate cuts, because the last thing they want is to see inflation surge again and then have to suddenly turn around and say to markets, we said we were cutting rates, well, now we're going to start raising them again, because that sends out really bad signals to the market. It makes the central bank look not credible, which is not good. And credibility is a big part of the magic, if you like, the kind of aura of competence around a central bank. And it makes monetary policy effective if a central bank is credible. So the last thing they'll want is to lose that credibility. So my point is that they're going to cut rates gradually, and as they do so, all that will happen is the rate of income on your money market fund will slow down. It won't collapse, it'll just slow down. Now, some people have said that there's going to be a stampede out of money market funds, which there might be. However, I don't think that's going to necessarily cause a systemic problem. And if it did, I think central banks would step in, because money market funds are seen as being systemically important. And certainly the Fed would, I think, step in. The Bank of England probably too. If they really point, I think, is the commercial paper market. So that's the least liquid component. These are short-term corporate bonds, IOUs effectively, with a very short duration. So we could see some of these money market funds gated very briefly, because the paper inside them matures very quickly. So you wouldn't need to gate it for long to get your money back. And, I think probably it'll go quite smoothly, because most of the stuff in the funds is very liquid. It's government bonds, which are very liquid, and so I think that won't necessarily be a problem that materializes. But it is something to be aware of, a stampede out of money market funds. But I think generally it's just going to be a slow cut, in which case you've got time to get out of that market. And you can be a little bit opportunistic when it comes to yields. So, for example, recently we've seen yields increase. So let's pull out the yield curve, actually, because that could be interesting. Let me just get it on CoiFin, because we've got a nice global yield thing. And I'll pull up US yields. I think I've already got the US 30-year, 5-year and 1 year. Yeah, let's just have a look at that. So this is the 1 year rate. So that's currently at 4.9%. The 30-year, which is at 4.1, and the 5-year, which is at about 4.0. So still got this kind of inverted shape where the long end of the curve is lower than the short end. And what you can see is that recently, since the beginning of the year, just before it, yields have been rising, particularly in the belly of the curve at the 5-year point and at the long end of the curve, the 30-year point. So I think, you can be a bit opportunistic. And if you do see these surges upward in yield, and this isn't really a surge upward, it's just a slow increase, but if you do see that, you can lock in those rates, and you can be a bit opportunistic and, wait around while your money market yield is slowly falling, and just choose your point carefully when you enter a fixed yield. I think that's probably worthwhile because, yeah, I think that we're not too far off fair yields at the moment, given where we are with nominal growth. Unless you're expecting a huge recession, yields are roughly where they should be at the long end of the curve, I think. Certainly on the basis of a simple model which I've used. So yeah, I don't think that there's a lot of leeway for yields to move a huge amount from where we are now, but you can be a bit opportunistic. So as yields grind higher at the moment, you could wait until you think they've kind of reached a level you like and then lock in the rate. And I think it's probably worth waiting a little bit longer. In the UK, we've got an election coming that often pushes up yields. But just today, if you look at Jeremy Hunt's Twitter account, you'll see that he was saying, oh, Labour says they're going to do this when they get into power. Oh, but they've got very little leeway, so they're going to have to raise taxes to do it, because the Conservatives have actually set a very little wiggle room in their previous budget, because they've given away a lot of money already. So unless there's huge GDP growth, which is looking unlikely before spring, then we're going to have very little fiscal room, and Labour is probably going to have to raise taxes in order to achieve its fiscal targets or whatever it wants to do early on in its if it does win the election, early on in its stint as the ruling party. So if they do get into power, what I'm saying is it's likely that there'll be lots of bond issuance to plug the gap between fiscal spending and revenue from taxes. So I think that could be another opportunity when yields will spike and you could lock in a higher rate. So just be opportunistic when it comes to locking in the rates is all I'd say, because there could be better chances, further down the road. And you've still got time to do it. It's not something that you're going to have to do immediately, because the rates are going to come down slowly. Great. So next question is from James Siddall, also a super chat. It's very generous. Thank you, James. And James says, I'm thinking of switching from VDWXEIA to VHVG for lower fees, but I'm puzzled by the difference in annual returns, as I thought the funds were fairly similar. Can you shed any light? Well, let's have a look. The one I'm not familiar with is VDWXEIA. Sounds like one of the US Vanguard funds. Oh no, it's not. Okay, and the other one is the one I've got, which is VHVG. So let's pull them both up and have a look at them. Yeah, and I'll do it on the Vanguard website, I think. Yes. Good. Okay. Share screen. So this is the one you were talking about. FTSE Developed World X UK. It's in sterling. It's an accumulation fund. This is FTSE Developed World, and it's not ex UK. And so the fee on this one is 0.14. They're both accumulation. Yeah, so they're both accumulation funds. The only difference between them is the fact that one of them is an ETF, and the other one is a fund. So in this case, I really wouldn't expect much difference in return at all. So let's have a quick look at the returns just to see the comparison. So I'll pull these up on SharePad just to get the. Let's put it into the temporary folder. Temporary. Just bear with me. It'll be worth it. Okay. VHVG. There we go. We'll add that one. And the other one was VW. I don't think that's a standard ticker. No, it's not. See if we can get the ISIN code. Yep, thank goodness. And we'll add that to the portfolio. Okay, and back to this, and we'll compare the two. Developed world. So those are the two, aren't they? So multi-graph, and we'll do the period when they're both. Yeah, so you can see they are very similar. There is a bit of difference between them, but very little, which is what you'd expect, because if they're buying the same stocks, they're both in sterling, they're both accumulation funds, there's not going to be a huge amount of difference between them. And that's exactly what we see. There will be some difference, obviously, because they don't buy exactly the same index. There is a difference excluding the UK, but the UK is so tiny, 4% of global markets, that excluding it makes hardly any difference to the return. In fact, my next video, which I've just made today, I just shot it today, it's with our editor, it's about the difference between the S&P 500 and the FTSE 100. And, you know, the FTSE 100, the UK market is so small now that you could exclude it from a global index and hardly make any difference to the returns. So that means that you really have to buy substantial amounts to move the needle if you think it's going to outperform, and move away from market cap by a huge amount if you've got a global index. So it is difficult. The fact that the UK market is so small, it's kind of entered this kind of doom loop in a way. But I tried to be positive about it, and there's a surprise at the end of the video, so you just have to wait to see what I say. But yeah, there we go. So to answer your question, I don't think there is a lot of difference between them. It is a very slight difference. Maybe it's because you didn't base them on the same starting point. Obviously the prices will start off at massively different points, so you always have to base it on total return rather than the actual level of the index. And if you do that, which is what we saw previously, you can see they almost lie on top of one another, which is what you'd expect. And it sounds like that's what you expected as well, James. Yeah, but the fees as well, very similar, 0.12, and what's the other one? 0.12. VHVG, which is the one I've got, is 0.12, and the other one is VVV. Have I got it? OC. Oh, here we go, 0.14. There we go. Right. Next question is from Mr. Hanlon. He's one of our supporters on YouTube. Nice to see you again, Mr. Hanlon. Happy New Year, Ramin. Happy New Year, Mr. Hanlon. Do you pay any attention to market timing whatsoever? For example, if you have some regular payment that you put in, do you hold off if, for example, things look overbought? I'm very tempted to, but I never do. And simply because if you do that, usually it's not going to work in your favour. Now, when I was drip feeding, I had a 2-year drip feed period when I'd been kind of thrown out of the funds I had by Vanguard, which shut down the funds I was invested in. And what I was doing was gradually building up my equity investment to 100%, which is where I am now, just one fund, VHVG. And I did that very gradually over time and over a 2-year period. And when markets fell, I was always tempted to hold off, thinking, oh, it'll probably fall a bit more. But I never did, because what I did is I just put a calendar reminder so that I'd buy at the same time every month. Because that's a really slippery road. Because if you do start delaying the purchases, chances are that you'll get it wrong. You'll get the timing wrong. So I think it's best to really be disciplined about that. And if you can automate it, again, that's another video that's en route. Then I think it really does help in terms of outcome, because usually the kind of biases that people have won't work in your favor. Often markets snap back very quickly and you won't be able to time it correctly. So I don't think it's usually a good idea to do that. I'd avoid it. But do I market time at all? Well, it's funny because I was talking about this with a client recently on a one-to-one coaching session, and I do actually time markets, but it's in a strange way. it's if there's a crisis. So let's say one example was in my fund it's always in my fund portfolio. There was this banking crisis in March of 2023 when US regional banks looked like there was going to be a systemic problem. Everyone was terrified. The banking sector ETF for the US tanked. And I thought, well, this could be a good buying opportunity because the Fed had stepped in. It was very clear the Fed wasn't going to let this spread and become a systemic problem. And they did. They did step in a special way. They had a special loan program so that banks could borrow at a rate of about 4% using the Fed's balance sheet and effectively pay people if they were fleeing their bank. So if there was a run on the bank, they could afford to pay people on the way out without having to sell their US treasuries, which caused the problem with Silicon Valley Bank, if you remember. But at that time, I thought, well, if the large banks like JP Morgan, which dominate this index, are they going to recover? Yeah, because US people still need banks. And it's just a matter of buying when it was cheap. And it took a long time. It took about 3 or 4 months. But now that index is up about 18%. So I think, I'm happy with that because I did have to time it because you buy it after the crash. That is market timing. But the important thing is to be patient while you're waiting for the recovery and always buy something which will recover. So my logic was the US will still need banks. Eventually the economy is going to recover. It's not in such a bad shape anyway. And this crisis has just pulled down the valuation of perfectly good, very strong balance sheet banks like JP Morgan and Bank of America, the really big banks in America. And that was just an opportunity, I thought, and that's panned out pretty well. So I do time things. I buy things during a crisis period if I think they're going to recover. Another one that's on my shopping list is junk bonds. Now at the moment, the spreads are still very tight on junk bonds. The all-in yield is pretty high because of the risk-free rate being higher. But I think there'll be even better opportunities if there is a little bit of a crisis in high-yield credit. In other words, higher default rates, people fleeing the market, widening that spread, and then making the income even more attractive. So I think that's definitely one on my list, which requires timing because I'm going to watch the spread. And if it blows out to say 7-8% on high yield bonds, on junk bonds, maybe even 9%, 10%, then that would be a screaming buy in my opinion. So I'd buy into that and I'd just be patient at that point and wait until it recovers, which it always has in the past. It could get worse before it gets better, but again, it's a matter of holding on. So I think I do time markets, but it is just in my fund portfolio, which is my try to beat the market, but no, I'm going to fail part of my portfolio. And that's why it's just 10% of my portfolio. So we're thinking of doing an episode in the podcast about the Kelly criterion, which is looking at how to size your trades. But roughly speaking, it's according to success rate. I don't think I can beat the market with a probability of more than 10%. So, that's why it's 10% of my portfolio. But it's fun, that's why it's a fun portfolio. I learn stuff from it, but I do time in that portfolio. Another thing I bought was US small caps. That's taking much longer, but that is gradually starting to pay off because the valuations were crazily low. And it got worse before it got better. Scottish Mortgage, another one that sold off a lot and I bought it. Tritax Big Box, which sold off, I bought it, then it sold off more. So that's taking much longer to recover. But, all of this is kind of timing. I buy into these train wrecks where I think a recovery is likely. So those are based on timing. So to answer your question, yes. So it's not things which are overbought, holding off. It's things which are oversold, buying them. That's how I time it. Next question. Super chat from McCready747. Hello, good to see you again. Is Anali Capital Management Inc. a yield trap? I hadn't actually heard of it, so let's have a quick look at it. Here we go. I'm just Googling. Okay, so let's read it together. A leading diversified... Oh dear. A leading diversified capital manager with a differentiated model composed of diversified investment strategies on balance sheet. Proven. Progressive approach, proven results. 25 years to be a stable source of yield for shareholders. And they've got great people. Great. So what have we got? 11 billion of permanent capital. Broad investment mandate across sectors and the capital structure, so they can buy bonds, corporate bonds, or they can buy equity, and I guess some exotic stuff in between. And a very high return since IPO. And is this a SPAC? I wonder. History. Here we go. Founded in 1996. Michael A.J. Farrell, Wellington Denahan. So it does look like it's simply a fund manager, not a SPAC. And let's have a look at the returns. See if I can find it on here. Nally Capital Management. There we go. So you can see the price has surged upwards. When was the surge? It was in literally, because it was the 26th of September, I think, 2022. And it kind of just had a leg upwards, didn't it? So what is it? An American mortgage real estate investment trust. Okay, so it's a REIT. Owns a portfolio of real estate related investments, including mortgage pass-through securities, certificates, collateralized mortgage obligations, that's CMOs, credit risk transfer securities, other securities representing interests or obligations backed by pools of mortgage loans, residential mortgage loans, and mortgage servicing rights. It's to generate net income for distribution to its stockholders. So, the questions I'd be asking is what kind of real estate are they buying? So let's have a look at the portfolio, if we can. Do we have a breakdown? I was hoping it would have a kind of portfolio breakdown, because for the REIT that's really important. No, I can't see that. Gearing looks pretty high, but I guess for equity, for mortgage REITs, you might expect that. Let's have a look at its Wikipedia page. I was trying to find the yield. Let's see if we can find the yield on it. I'm hoping this is going to be on Yahoo. Yield. Price to earnings irrelevant. So dividend yield, is that right? 13%. So I guess that's your point, which is that the yield is high, but perhaps it's a kind of yield trap, because maybe the price is likely to fall. So I can't really judge on the basis of this. What I'd like to see is what kind of real estate sector it's in, and I can't figure that out from the from this description here. I mean, if it is diversified across different types of mortgages, I mean, the things I'd be worried about in the US at the moment are, with US yields surging upwards, if you've got exposure to the real estate market, then you're always worried about foreclosures on properties, which are probably going to start rising now as people are forced to move. Obviously, in the US, you've got 30-year mortgages, so you don't have to move. So people will stay put if they can. But sometimes, due to death, divorce, whatever, you have to move. And if that's the case, then you have to refinance at a higher rate, which can be a problem. It is a problem now. It's several times more expensive to service that mortgage, a same size mortgage, now that rates are much higher. So that would be my concern. Now, at the moment, US growth is still strong, so people can find jobs, they can still get a wage, so that's a positive. However, what isn't a positive is those financing rates. So if there is a sign that there is more distress in the mortgage market, I'd be slightly concerned. So whatever the yield is, you'd be thinking, well, am I willing to take a capital hit? Those would be my concerns. And then there's a question of leverage. If it is a leveraged REIT, if it's heavily leveraged, you'd be thinking, if there is a downturn in the MBS market, do I want exposure to that, leverage exposure to that right now? But you're right to say if the yield is high, what's the risk? There is always a risk if the yield is high. And I think that's the risk at the moment, would be my guess. Although, you were watching me kind of Google around, but I'm not sure what the specific exposure is for that REIT. But that's what I'd be looking at. What's the portfolio like? And if you're really going to buy into it, then you probably need to know that. You could probably get it off their website. You could get the portfolio that they invest in. But obviously on a YouTube live, I probably don't have time to do that. And you probably wouldn't want to watch me read a 100-page document. So other than that, those would be my general thought. That would be my general thought process if I was going to buy into it. Obviously, I lived through the MBS sell-off and the ABS sell-off in the 2008 route. So I'm very sensitive to the potential pitfalls in that market. So yeah, those would be my concerns. Oh, nice to see Amir Ketobchi. Nice to see you again. And Amir says, hi, Happy New Year. Just a high five to say keep up the good work. Khayli Mamnoon, Amir. Thank you very much. Also, how did you teach your own kids financial literacy? Any tips for under 10s and also for teenagers? Well, let me pull up a tweet which I did recently. Unfortunately, it skipped a generation. My kids, absolutely no interest in finance or what I tell them. So I think there's zero chance of them ever kind of looking at the stuff which I do or becoming financially literate. If they ask me, I will definitely help them as much as I can. But at this point in their lives, they're more concerned about university, getting through their courses. My son's doing a course on creative writing. My daughter's doing product design, and they're getting on with their lives. So they don't really want to talk to their dad about finance. That's the last thing they want. But let me just show you the counter example, which is what happened at Christmas. So there was a bit of an episode, and I tweeted about it. Let me just see if I can find it. Yeah, here we go. Now, some people said this was child cruelty, and I'm not sure what you think on the YouTube live. I'd be interested to hear what people think. So this is my partner Laura's grandson, and what we said was he didn't like sprouts, or at least he said he wouldn't eat them. I don't think he'd really tried them much, but we said if he ate 30 sprouts which were left on the dinner table at Christmas time, we said if you eat them, we're going to fund your ISA. So we're going to seed fund it. And I think he got over 100 quid if he ate these 30 sprouts. And you can see he was struggling, poor lad. But this was a sweet taste of capitalism, I said in the tweet. Slightly bitter taste of capitalism initially, but what sugar-coated it was the cash he received afterwards. And he did it. He did really well. He ate them all. And he was very pleased. So, yeah, well done him. And so that was his introduction to financial literacy. But also, I think what's interesting is that he said to me, will you teach me how to invest as we go along? So we'll put the money in, but we'll also discuss how to invest it. And initially we put it into a global index, but we can discuss what kind of returns to expect over his lifetime. And because he's 14, by the time he's 60, increase probably tenfold in real terms every pound that we put in. So well, I'll just make all of that really clear to him. So I'm also tutoring him for his maths GCSE, poor lad. So that's what we may end up discussing during one of those GCSE teaching sessions, a little bit about finance. No derivatives yet, we'll break him in easy. But anyway, that's the face of joy that he had when we gave him the sprouts. And as Dan Brocklebank of Orbis said, that's the bitter taste of capitalism. And someone also said, that is mean, but it will be earned. And then someone said, surely this is child abuse, which I don't agree with. I think it's just a good education in finance, a good grounding. But there we are. So, I do teach my kids if they ask, but they never do. But I'm sure they will in the future. But it is very difficult as a parent teaching your kids. I've taught other people's kids. Often we have the entire family on the call. You're doing one of these coaching sessions. Sometimes it's a baby. I can't teach a baby, but the young kids I can teach them some of the important things about investing. And the earlier you start, I think, the better. To answer your question, Amir. Anyway, next question. Another super chat. Thank you very much. We had loads of super chats today. This is from William Hayward. I'll just have a swig of water. Do like and subscribe. I should have said that. We're 42 minutes in and I didn't say it except at the right at the beginning. Yeah, please do like and subscribe. William Hayward, who's done a super chat. Thank you, William. I've just opened a Vanguard Children's ISA for my son, age 2. Very sweet. What funds or fund would you recommend long term? Thanks for the content. Well, in the case of children, it's pretty easy, especially if they're very young. So he's going to be invested for, he'll have control of it when he's 18. So we're talking about 16 years of investment. Now, over that kind of period of time, what you want is ideally an accumulation fund, because then you don't have to reinvest the dividends. You don't have to be very hands-on. You just fire and forget. And you probably want a large proportion in equity, because over an 18-year period, that'll almost certainly give you the best returns. So stocks rather than bonds. And you don't have to go for anything other than a global index for your child. And just the cheapest fund you can find that gives them global exposure. And at the moment, you can get funds for about 0.15%. You saw the one I've got, VHVG. That's pretty good. The fund fee there is 0.12. If you stick to developed markets, usually the fee is a little bit lower. But if you're doing it over 18 years, maybe you want to include emerging markets as well, in which case you go for a global fund. There's one that's just been launched by Invesco, which has a fee of 0.15, I think. I talked about it on my One Fund to Rule Them All video, which is FWRG. Let me just pull it up. That's pretty low fee. And where is it? I'll find it on the Invesco website because they're the issuer, of course. And in fact, I've just bought this one in my Invest Engine account. Here we go. So let me share. So this is the one. The fee for this one is 0.15. It's an accumulation fund, so you don't have to worry about reinvesting the dividends. And the expense ratio is pretty low, and it is an all-world index, so it includes emerging markets as well. Now, any of these global funds will be fine. Just choose one with a low expense ratio, which is accumulation, and you'll probably be fine. And, obviously, as the child gets older, you can explain what you've invested and why. And that could be a useful conversation to teach them about markets, because the best way to do it is to learn, is to have skin in the game. And they will have skin in the game because you put it there. There we go. So, that's probably the best choice. One of those global stock funds for a fee which is as low as possible. And there's so much competition in that space now in the UK. that the fees are going down all the time. So check once in a while just to see if there's a cheaper fund which is available. That one's an ETF, so any ETF only platform will have it. On Hargreaves, it'll also be cheaper if you have an ETF rather than a fund. So just be aware of the fees on each platform, because some platforms, if you have a fund rather than an ETF, it can be more expensive. So just check on your platform whether that's the case. So all in, we're talking about a very low fee for that one. Next question is from Stephen J. Oh, interesting. Stephen J is one of our supporters on YouTube and a regular watcher. Thank you, Stephen J. He says, Robert Shiller warns of cataclysm for US dollar reserve status if confiscated Russian assets are given to Ukraine. He warns that if the US does this today, then tomorrow the US could do it to anyone. Yes, I mean, the thing is, the US is in a very special position in the sense that it's the biggest capital market in the world. You can't really avoid it. It's very difficult to avoid it, and usually you'll pay some kind of return penalty if you do, certainly a risk penalty. It's the deepest, safest capital market on the planet. So I think people will always have that willingness to invest in US assets. Everybody wants to buy a slice of apple. It's just what everybody wants because it's just such a large market. But the US dollar is in a similar status at the moment, and Schiller's point is a fair one, which is if they start using the dollar as a weapon, then their enemies will start avoiding the dollar if they can, and perhaps other currencies will get a reserve status, and we'll end up with a kind of multipolar world. But in a sense, we've already got that. If you look at bilateral trade, for example, some of it's done in dollars. So let's say we've got two countries in EM, they might trade in dollars, or they could trade in their local currencies. What's special about the dollar is that in that bilateral trade, often people choose to use the dollar because of its stability. That might go away, true. But I still think, what would the reserve currency be if it wasn't the dollar? The next largest currency which is used for trade is the euro. But is the euro going to supplant the dollar? I don't think so. Not at this point. Would it be the renminbi, a currency which isn't fully convertible? Very unlikely. Maybe it will be within the kind of sphere of influence of China for bilateral trade, but it's not going to be a reserve currency. So I think a lot of this kind of reserve currency conversation is overhyped. I think in my lifetime it's unlikely that the dollar is going to lose its reserve status. And even if it does, I don't think that's a catastrophe for the US. The US economy would be fine if it did happen. And in some ways, being the reserve currency is a curse. So I don't think it would be a catastrophe for America if Russia did decide not to use the dollar ever again, or if it lost its reserve status overall. But yeah, his point is a fair one. Weaponizing your currency, America's probably the only country that could get away with it, put it that way. But Cataclysm, I think that's just hyperbole. And I'm a bit surprised he said that. I mean, I love Robert Shiller, so I'm surprised he said that. But yeah, I don't think I agree with him. Next question is from, let me say this correctly, Baskevis Swanath, and 2009. And it's a super chat, thank you very much. And the question is, I've exhausted my tapered annual pension allowance, are you a doctor, and ISA allowance. Is there any other tax efficient investment, or is it better to pay off my mortgage? I'm an additional rate taxpayer. Well, there are various things you can do. I mean, a lot of the pension crafters were buying government bonds when the yields were still fairly high. They're still pretty high at the short end of the curve, and the beauty of those is that you don't pay capital gains tax. So you can earn 5% without paying capital gains tax. if you choose a bond which has a low coupon. So if you look at the total yield, 5%, then a larger proportion of the yield will come from income if the coupon is low, will come from capital gain if the income is low. Let me just show you an example of that from our website, because we've got a tool that can help identify these low coupon bonds. This is just one of your options, right? So I'm just kind of talking through them. So I'm just going to launch the trackers. So if you are a member of our community, you get these trackers. Let me share my screen. And the one we're going to look at is this macroeconomic tracker. There are also other trackers, things like savings and retirement. There's a Monte Carlo simulator. There's one for stock valuation. There's a fair value model for gold. One for monitoring markets, which is kind of cool. Anyway, let's look at the yield curve in the UK. Hope this works. Okay. I'm sure it does. I trust Patrick, my colleague, who keeps it up to date. So the short end of the curve, you can see the yields that are around, now below 5%, so around 4.8, 4.9 at the really short end of the curve, and then it kind of slumps down to around 3.5 at the 5-year point, and then it kind of picks up again. So if you do choose one of these bonds with a low coupon, like TG24, or even better, TN24, which is not far off maturing, that's going to mature on January the 31st. But there you'll pick up a yield annualized of 4.7%. And then what you can do is you can run a bond ladder. As each one matures, you buy the next one. You just got to make sure you choose the ones which have a big circle on this tool, because the size of the circle is proportional to the amount of return that comes from capital gain, where you don't pay tax. So that's the way I'd approach it. That's one choice at least. What are the other choices? Well, there are things like EIS, much more risky, or venture capital trusts, again, very risky. Venture capital trusts are actively managed funds, usually with very high fees, where you buy portfolios of early stage companies which aren't yet listed. And in order to make that attractive for investors, the UK government gives really good tax breaks, such that if you hold the investment for 5 years or more for a venture capital trust, you immediately get this, well, you get this 30% tax break. So just if you don't have any gains at all on the fund, you get very beneficial tax treatment. So that's one choice that people often take. That's one choice that people often use if they've used up their SIP and their ISA. But it is risky because these are early stage companies. They're UK based, so not geographically diversified, and you have to rely on the manager to do a good job of not choosing no-hopers. And if we are entering a period of weak growth, then these early stage companies will probably suffer. So that's another choice. EIS, enterprise investment schemes, that's another choice. You do get very beneficial tax breaks. Again, it's early stage companies, it's very concentrated, so you have to choose the company very carefully. And again, you get very beneficial tax treatment if you do that. So you often buy them for the yield rather than the capital gain. You're not going to buy the next Google, but you do get very tax efficient investment if you do that. So those are the other choices. Beyond that, there isn't really that much out there. So those are the things I'd consider. But be really careful when you choose those more risky schemes, because the risk of capital loss is pretty high. Just be aware of that. Am I going to get through the rest of them? I'm going to have to speed up. What time is it? We've got 6 minutes, so we might have to speed up. Next question from S. Cox. Again, a super chat. Thank you very much. Risk management question. I used to work in risk management. For a long-term investor, is a stop-loss strategy for an ETF a good or bad idea? Could it prevent catastrophe during a crash or lock-in losses? Well, it's interesting. We had a conversation about this on our chat channel in the community on PensionCraft, because somebody had set a stop loss on his fund, but then there was a kind of glitch in the pricing, And then what happened is he got kind of a forced sale, and then the market rallied, I think. And it was just like a false glitch in the data. And he complained about this. I don't think he got compensation. So just be aware that, you can have these very temporary blips which essentially trigger the sale, and they trigger it in an inappropriate way. So you could be locked out of a rally, and that's a risk. Most falls in markets are temporary. So the problem is always what happens if you get a forced sale, if you hit the stop loss, but then the market snaps back very quickly and you don't have time to buy back in. Essentially then you'd have a kind of like a crystallized loss, and you'd have to buy back in at a higher price. So that can be a problem. So I'm not convinced they're a good idea. The weird thing is that when you get a market fall, you often get the biggest rallies after one of those falls, and usually the falls are very short-lived. If you do a statistical analysis of crashes on the stock market, most of them are kind of short, sharp falls, like the one we're seeing at the moment, probably at the beginning of 2024. So if that's the case, then the stop losses are not going to help you. But in the rare case where you do get a big fall, so 30% or more falls of over a 1 year period only happen with a probability of 2%. 2% for a 30% or higher fall over a 1 year period. So it is very rare, but you'd be glad of it if you did it. But personally, I never have stop losses. I don't think it's particularly helpful. I just ride it out. If markets fall, you can always invest more. That's another way to approach it. It's a sale. But personally, I don't do stop losses. If you are risk averse, then think about diversifying rather than having a stop loss. That's probably a more efficient way of smoothing out your portfolio returns. It's tried and tested, right? And with money market funds yielding 5.2%, your safe bucket is now very attractive in terms of return with very little risk. Next question from Daniel Madsen. He's paying us in kroner, Danish kroner. So I assume you're based in Denmark. I have an MSCI ACWI, that's the All Country World Index, that's a global index, due to tax benefits, but FTSE All-world holds more companies. Is there a big difference? Is a world ETF still a good place to be? Well, a world ETF is what I've got, just developed. I've got, rather than developed and EM, which is what you have. But the number of companies, if it's, like 2,000 or 2,500, which is what we're talking about, all of the diversification benefit usually comes after the first 20, 30 stocks. Beyond that, I'm assuming that they're from different sectors. Within a sector, usually there's more correlation, so you get less diversification. But if you have different sectors beyond 30 stocks, the diversification benefit falls off very slowly. So if it's a difference between 2,000 and 2,400 stocks, almost no benefit of the diversification. The returns will be very, very similar between those two indices. Not identical, but very similar. And is a world ETF a good place to be? Yes, I think so. If you're going to be in there for a long period of time, then I think it makes absolute sense to have that as your core holding. I'm living proof, that's what I invest in myself. So obviously I believe it's a good thing long term. So yes is the answer. I think that's definitely a good place to be. Next question is from JK, also a super chat, thank you very much. And JK says, I found a cheaper global ETF with a 0.05% fee. Yes, I saw this one as well, it's PRIW. Instead of yours that is a 0.12% fee. Well, remember I'm on Vanguard, so I've got limited choices. It is small though, you say. What do you think about it? It's a Amundi Prime Global UCITS ETF. And you've got the ISIN code. Yeah, I'm aware of it actually. I was actually looking at that one and thinking, maybe I should go for that. I might do that actually, now that you mention it. Let me just pull it up here. Uh-oh, it's Amundi. Oh no, it's working today. That's good. Sometimes the website doesn't work. Yeah, here we go. So this is the fund you're talking about. Yeah, the ticker is PRAW. I think the one I saw was PRIW. It's probably two different versions of the same fund. Yeah, I think this one, is it in dollars? Anyway, yeah, it's the same fund, I guess. But the fee, like you say, very low, 0.05. It's a physically replicated index, so it buys the actual stocks. So there's a lot going for it. And it's accumulation, I think. Yeah. So, yeah, I think could consider that one. Not a bad idea. I might go for that myself. Yeah, but look, all of them, if you can find a cheaper one, go for it. Because, you know, have a look at the returns. Just make sure that it's not egregiously bad at tracking and it's from a reputable manager, which Amundi is. Then, you know, just find the one which is cheapest, which gives you the exposure you want. And I was looking at that one, yeah. So I might switch myself, actually, on my Invest Engine account. Brilliant. So next question is from final question, no, penultimate question. Rocky Cottage, good name. And Rocky Cottage says, as an alternative to bond fund allocation and retirement, is there merit in holding an extra year of cash, money markets, gilts in the buffer, which could be diverted to stocks in the event of a crash? Yeah, dry powder. Yeah, I mean, if you've got a huge excess of savings, so let's say you've got, I don't know, something crazy. Okay, so like 5 million, and you're not worried about the return on all of it. So just investing the 3 million in equity and not touching it is going to give you a long-term inflation busting return. Then you can play around with the remaining 2 million and invest it in something like a bond ladder or a money market fund, and that way you've got the dry powder if there is a crash. And these crashes can be life-changing because they offer these incredible buying opportunities. So I think, yeah, if you've got the capacity to do that, Rocky Cottage, yeah, why not? Why not have that dry powder and have it ready to deploy in the case of a crash? Yeah, I think that makes sense. But just be aware that there is a drag of safety. So if you have a large allocation to cash or money markets or gilts, then that will underperform almost certainly by around 4% per year over the long term. So that's the trade-off. You know, but the returns that you can get from buying into these crashes can be incredible. So being a contrarian really works if it is a recovering index like we discussed earlier. So I think, yeah, as long as you've got the capacity to do it, Rocky Cottage, and you're not worried about the cash drag, the kind of underperformance, then certainly having some money put aside as dry powder makes sense. But also most people in retirement do have that safety buffer in the kind of cash allocation, which is for kind of liquid savings in case of emergency, and which you might need to draw on very rapidly. So if it's there anyway, you can always deploy some of it in one of these crashes. Just don't put too much in there because that would be a drag. Final question from Kevin in the UK. He says, sorry to ask such a basic question. Oh, a good one. Why do bond prices go up when the yield goes down? You can explain this really simply. Let's say we've got a 1-year bond and we've locked in a fixed rate of interest of 3%. Now, when we bought the bond, we knew the return would be 3%. Everyone was happy, you know, we knew what we'd get. But then the day after you bought it, yields suddenly go up to 4%. Well, you've locked in 3, so you don't get that. If you wanted to sell your bond to someone else today, you'd be missing out on 1% for 1 year. So the price of your bond would fall by 1% to compensate for that lack of return. So that's the way to think about it. If you had a 2-year bond paying 3% and the yield went up 1%, then you'd be missing out on 1% for 2 years. So in that case, you'd miss out on 2%. So by looking at how long you've locked in the rate of interest, which is fixed, you can see what the multiplier is for working out how much the price of the bond falls if you've locked in a fixed rate. So really it's about opportunity cost and what people are willing to pay you for the bond you've got, given its fixed coupon. If interest rates go up, your bond looks less attractive, so you have to pay them more capital gain in order to compensate for the loss in yield. And the two exactly match one another with the bond. So it's all very predictable. So higher interest rates means lower price for the bond. Another way of looking at it is you can just discount the future cash flows. And if you're discounting at a higher rate, then the price of the bond falls. But that's the equivalent. It's actually equivalent to what I just said previously. But people often find that explanation more intuitive about locking in rates. So that's the way it works. That's why there's an inverse relationship between the two. Anyway, look, thank you all for joining us. I've run over slightly, but I did get through all of the questions, and they were great questions as always. Don't forget our podcast, well worth a listen, about demographics and their effect on markets. Don't forget to like and subscribe. And remember, I do one-to-one coaching if you want to speak to me directly. And of course, we have our membership. So go to our website, PensionCraft.com, if you want to get access to those trackers, or if you want to access Slack and ask a question whenever you want. And of course, we've got a huge library of members-only content, explainers, on almost every topic I think we've covered now. So thank you all for joining us, and have a great evening. And I hope 2024 equity markets pull out of this funk and things improve a bit. So good luck with your portfolios, and we'll speak again soon.